Hello, and welcome to PubK's 2022 Government Contracts Annual Review. We're thrilled to have more than 3,000 session registrants for this annual program. On this day 3, we've already held 8 different sessions, with one more this afternoon after this. We hope you'll be able to join us for the remaining sessions today, as well as the 2 tomorrow, but a separate registration is required for each session if you want to attend. You can register on the PubK website. My name is Alan Schwatkin. I'm the president of the PubK Group and a partner in the law firm of Nichols Slew. I'll be your host, facilitator, and moderator for the annual review. And I hope we can convene next year in person. The PubK Group consists of 3 newsletters: PubK Law, PubK Compliance, and PubK Cyber. Many of you are already subscribers to one or more of these publications. We very much appreciate your support. Why not subscribe to all 3? Some of you are not yet subscribers to any of these publications. I hope you'll consider becoming a subscriber. Again, for all 3. Information is at the website shown on the slide or is available from any of the contacts you have here at the PubK Group. This conference would not have been possible without the strong support of our event sponsors, all of whom are listed on these next 2 slides. I encourage you to look at the skills and capabilities that these firms have. In lieu of speaker gifts and in honor of our sponsors, PubK is making a contribution to the Capital Area Food Bank. I hope you'll consider making an individual or organizational contribution as well. Since the entire program is being held virtually, all attendees will be in listen-only mode. Your video will remain disabled throughout the session. But we do welcome your questions. Use the Q&A box at the bottom of your screen. However, with so many attendees, it won't be possible to answer all the questions in real time. We are capturing your questions and will endeavor to answer as many as possible after the conclusion of the annual review. However, all presentation slides along with the audio will be available for download from the PubK Group website, probably within a week or so of the conclusion of the annual review. We'll send you an email when this information is available for download, how to access it, and for how long the material will be available. You can also follow us on LinkedIn and bookmark our YouTube channel. For those of you who are interested, we're applying for continuing legal education in a number of jurisdictions. While we cannot guarantee approval, we expect that acceptance within the next few weeks. Again, we'll notify all attendees when those approvals have been received. Finally, if you're interested in obtaining CLE, please look for our poll question during the presentation. State boards require us to verify your participation during the event. The poll question is a simple yes, no, and we'll keep track of the responses. If you don't wish to obtain CLE credit, you can disregard the poll or just answer it for fun. Now I'm thrilled to continue the 7th PubK Annual Review with our Session 9 panel on small business contracting. Our distinguished panel members are Matthew Schoonover from Schoonover and Moriarty, Shane McCall of Caprice, and my friend Sam Lee, who is the Assistant General Counsel at the U.S. Small Business Administration. Sam, let me turn it over to you.
Thanks so much, Alan. Thanks for having me today at the Public Contract Law Conference. And I'm Sam Lee. I'm with the Office of Government Contracting and Business Development at SBA. I'm coming to you live from Annandale, Virginia, home of the Mochi Donut. So Alan, if you're able to create a subscription for a Mochi Donut, I think I'd be one of your first subscribers on that as one of your 4th offerings. So I come to you today to first go over one of the biggest policy developments in small business that I've seen since I've been at SBA, or at least one of the biggest, and it's comes straight from the White House, an OMB memo that was issued in December to recognize some of the trends, worrisome trends that have been occurring in small business contracting with the federal government, and to address the presidential priorities of advancing equity within the American economy as a whole, but particularly in government procurement. So first, you see here on the screen the trend, the declining trend in the number of small businesses that have been working with the government. Over the course of a decade, the number of small business vendors working with the federal government has dropped by 40%. And you can see that there was a precipitous drop leading up to sequestration. Then when that ended, it leveled out a bit, it came back even. But since then, there's been a gradual decline, so that now in 2020, which is the last year for which we have full data, the number of small business vendors was below 70,000, down from over 120,000 a decade before. If we go to the next slide, you'll see that the trend on bringing new entrants into the federal government seems like it's even worse. If you take this out, the number of new entrants has declined even more steeply, meaning that the government has potentially less access to innovative products that small businesses provide, new services like artificial intelligence or revolutionary public health products. And this is something that SBA has been recognizing for a couple of years, but fortunately, we've been able to get the attention of others in the executive branch. And so earlier, a few months ago, at the end of 2021, the White House decided to take action. We'll see that on the next slide here. Following up on the president's day one executive order on advancing equity among underserved communities, which is Executive Order 13985, the Office of Management and Budget issued a memorandum on advancing equity specifically in government procurement. It's OMB Memo M2203 from beginning of December. And as I said, it's one of the biggest actions that any White House in my memory has taken on small business procurement specifically. This is a document that's aimed specifically at reversing those trends in declining small business vendors and trying to bring new small businesses, and particularly those businesses that operate in underserved communities, into the government marketplace. The memo altogether has 5 initiatives. First, the OMB directed agencies to increase their spending with small disadvantaged businesses. Those are businesses that are owned by socially and economically disadvantaged individuals. Firms can self-certify as small disadvantaged when they register to work with the federal government. There used to be a SBA certification over a decade ago, but the official certification program for small disadvantaged business has turned into a self-certification program. However, SDBs can apply to the 8A program, and that's a certification program that comes with additional benefits. Altogether, the agencies will increase their spending with small disadvantaged businesses so that the government-wide spending with SDBs is targeted to go to 11% for this fiscal year 2022. Prior to that, the goal for contracting with SDBs was just 5%. So this is a major increase in spending with small disadvantaged businesses. And it's going to go up even more, up to 15% by fiscal year 2025. So you're looking at a change in the goal for SDBs from 5% just last year all the way to 15% in just 4 years. And then second, OMB addressed something that SBA and many small businesses have had on our minds for quite some time, the category management program, which is a government-wide program to have agencies purchase as one government and consolidate their purchases with fewer contracts, and that has led to agencies purchasing from fewer contractors. There are 3 major changes to the government-wide category management program. First, and this was the one that SBA really pushed for and that we were able to convince other agencies about, was to grant automatic category management status for socioeconomic small businesses. These are SDBs, women-owned small businesses, historically underutilized business zone businesses or hub zones, and service-able veteran-owned small businesses. This means that all those businesses, which is about almost 50% of small businesses working for the government, will automatically be included in category management at the tier 2 level. That means a specific thing to government buyers, but it basically means the government buyers don't have a disincentive for working with those businesses because they have to follow category management guidance that tells them they need to work at tier 1 or tier 2 or tier 3. If they work with these businesses, it's automatic that it's counted as tier 2. And then the category management guidance was changed by OMB to reinforce the importance of small business goal achievements like that 11% that we talked about, so that agencies don't ignore their goals in favor of trying to consolidate their purchases and work under the existing category management guidance. So reinforce the importance of small business goals. And then third, SBA and our partners at the Department of Commerce in the Minority Business Development Agency are now voting members of the Category Management Leadership Council. So SBA has a voice in determining the path, the future path of category management, so that small businesses don't get left behind in that program. Going on with the other 5 initiatives, the OMB also recognized that decline in new entrants, and so there's going to be a special program to try to increase new entrants and at least track that for the future so that we can reverse that decline in the small business supplier base. And then more internal to the government, federal senior managers and executives will be accountable for small business goals. It'll go into their performance plans. And then the OSDBUs, the Offices of Small Disadvantaged Business Utilization, will have access to their senior leadership. That's at least the deputy secretary level. And those agencies have already reported to OMB and SBA on how they're implementing that requirement to have that reporting to senior leadership. And next slide. So along with this, in addition to the White House and the OMB announcements, SBA also took on our own new initiative to release disaggregated data on how particular ownership groups are faring in contracting with the government. So you can see here, for the first time this year, SBA released disaggregated data to show where that disadvantaged business spending is going. Owners self-report when they register in SAM.gov as to the race and ethnicity. And so for the first time, we released this data to make that transparent to the public. Next slide. So what's nice about that disaggregated data is now it can be used by researchers to conduct analysis across the federal procurement and compare it to the wider economy. So you can see here, for example, let's just take Black American owned firms. Black Americans own about 9% of total US firms. Own about 2% of US employer firms, and they receive about 1.9% of federal procurement spending for firms owned by Black American business owners. And so SBA is committed to release this disaggregated data on an annual basis, and that'll enable studies like this. And you can actually go to, if you look up the Council of Economic Advisors, you can see their full analysis of how particular groups are faring in government procurement. And they also have some interesting points about how improving those numbers for some of these groups can lessen or tighten the racial wealth gap and bring earnings and income closer together among the various groups. Next slide. So 2 more things I wanted to mention before I turn it over to Shane and Matt. There was an interesting case that came out of the Court of Federal Claims at the end of last year on an 8A issue. Now, you know, in the 8A program, certain groups, certain businesses have special preferences, and this was one involving a native Hawaiian organization firm named Kapili. Kapili is in the 8A program, so it can receive sole source awards at any level. And in this case, the Defense Threat Reduction Agency, or DTRA, had been contracting with a company called Quanterion, but decided to take that contract in the 8A program and award it as a sole source contract to Kapili. And this case illustrates some of the processes that happen when an agency offers a contract to SBA, particularly as a sole source. When the agency submits that to SBA, SBA is required to conduct something called an adverse impact analysis, which says that if the contract would create an adverse impact on the incumbent contractor, then SBA won't accept that as an 8A contract. But there's an exception to the adverse impact analysis. That exception applies when the contract is a so-called new requirement. And in this case, DTRA suggested to SBA that this was in fact a new requirement, that what was being proposed to be performed by Kapili was different from what Quanterion had performed during its incumbent contract with DTRA. Well, SBA accepted the requirement, but SBA accepted it on the ground that there was no adverse impact to Quanterion, and Quanterion protested first to GAO. GAO dismissed it because of procedural reasons, and then it went to the court. And at that point, SBA realized that its initial ground had been falsely or incorrectly stated, had been incorrectly stated, And so SBA went back and took a look at that new requirement issue and found that DSHRA was reasonable in finding that this was not a new requirement. On the subsequent challenge to the Court of Federal Claims, Judge Charles Leddow dealt with two issues, and it was really quite an elegant opinion, because he was able to kind of split the middle on some of these issues and say, even if this is true, we don't have to decide this issue. First, the issue was this really a new requirement? And that got into some questions about whether to be a new requirement, something has to be over 25% more and have new work, or it could be either. And Judge Leddow said, look, it doesn't matter. One way or another, this is going to be a new requirement because it's both much larger than the previous contract and it has a lot of new work. So the judge agreed that DSHRA was not unreasonable in telling SBA that this was a new requirement. And that gave SBA that basis to not perform an adverse impact analysis. Then the second issue was how SBA should treat capili size. Because what had happened is, between the time that DSHRA had initially submitted this to SBA and the point that SBA conducted its follow-up analysis, capili had become a large business. It had lost its small business size status. And SBA had a couple of rules out there, one in Part 124, another in Part 121, that looked in two different directions on whether to treat capili as a small business or a large business. And Judge Leddow said, well, I don't have to worry about which of these rules is right, Part 124 or Part 121, because either way, this still can be an 8A contract. And Quanterion is not an 8A firm. Even if it's not capili that gets the contract, it still can be an 8A contract. And because Quanterion is not qualified as an 8A firm, it does not have standing to bring this argument against SBA and DSHRA's decision. So this case really illustrates the principle of adverse impact in the SBA 8A program, as well as a new requirement rule. And Judge Leddow's opinion there is notable for its elegance. Next slide. And then one last point before I turn it over is SBA is, right now we have 3 certification programs. We have 8A, we have women-owned small business, we have service-able vet, and we're adding a 4th one based on the National Defense Authorization Act for 2021. SBA is taking over the service-able veteran-owned small business certification from the VA to SBA. Not only is that going to apply for firms that work on VA contracts, but it's going to be government-wide, which is changed from the way it is right now. Right now, you can self-certify for, say, a DoD contract, but when SBA takes over the certification starting January 2023, firms will have to be certified by SBA or have provisional certification because they have self-certified, they have a 1-year grace period, or have been certified by the VA in order to compete for set-asides for service-able veteran-owned small business contracts and for veteran-owned small business contracts from the VA. And I'll go on to the next slide and hand it over to my colleagues.
Well, thank you, Sam. It's a pleasure to be with everybody today. I'm Matt Schoonover. I'm the managing member of Schoonover and Moriarty. We're a Kansas City-based law firm that works exclusively with small business federal government contractors. And I'm delighted to join Sam and Shane today to talk about just a few more of the regulatory updates that we've seen for small businesses. The first thing I'll talk about very briefly is updates to size standards and how to calculate those size standards. The next thing I'll talk about is kind of the rule of 2, when it applies and how it applies, and we'll discuss 2 differing decisions, one from the Court of Federal Claims and one from GAO, that discuss the applicability of the rule of 2 or not. And then the final thing I'll talk about is something near and dear to my heart, and that is essentially joint ventures, small business joint ventures, and more specifically, a recent case on how to classify or how to account for revenues of the joint ventures that may not meet SBA's requirements when we're talking about small business size eligibility. So the first thing we'll talk about, as I mentioned, is the calculation to size standards. And really the first big thing to cover is essentially the 2021 National Defense Authorization Act. Section 863 of the 2021 NDAA kind of carried the mantle, Congress's mantle, of trying to essentially help small businesses be small for a longer period of time. Congress is concerned about the impact on growing small businesses, and once they kind of graduate their size standard, suddenly thrusting them into competition with large businesses. And so we saw it in 2018 that Congress issued what was called the Runway Extension Act, and encouraged SBA, there's some dispute, encouraged SBA to change its size standards for receipts-based calculation periods from 3 years to 5 years. Those receipts-based calculation period, again, receipts are total income added to the cost of goods sold as those items are reported on tax returns. The old rule was that SBA would determine size under a receipts-based size standard by looking at the average of the preceding 3 completed fiscal years. Well, the 2018 NDAA and then SBA's updated regulations changed that essentially to 5 years. At first, SBA allowed for a grace period to have that calculation from 3 or 5 years. The company could choose its calculation period. Now, however, it is a 5-year receipts calculation period. So under the receipts-based NAICS codes, supplies and service-based NAICS codes, those are for, or services-based NAICS codes, excuse me, size is calculated under the prior 5 completed fiscal years. Congress has tried the same thing with employee-based size standards as well, which apply to manufacturing and supply-based NAICS codes. Currently, the rule says that employee-based size standards are calculated based on the preceding 12 completed calendar months, or the payrolls over the 12 completed calendar months. 2021 NDAA encouraged SBA to, or instructed SBA to change that from 12 to 24 months. So late last year, we did see SBA issue its proposed rule to implement that change. It changes the employee calculation period from 12 to 24 months. It also plays with the calculation period for various SBA lending programs. It does implement that 5-year receipts calculation period for those. We haven't seen the final rule yet on this one. Comments just closed at the end of last year. I would suspect, however, that we would see this change come very, very soon. Hopefully, probably in effect this time, maybe later this year or by the end of 2022. So that's the change to employee-based size standards. It is changing from 12 to 24 months. Next slide, please, Bill. All right, the next thing we'll talk about is the rule of 2, most specifically the FAR rule of 2, the rule of 2 under FAR 19.502-2B. And we have kind of 2 competing viewpoints here about when the rule of 2 applies versus when it doesn't apply. And the first case I want to talk about comes from the Court of Federal Claims. And this was a 2020 case, and I know we're here in 2022, but it was late enough in 2020 that I think it matters. And essentially what happened in that case is the Army Mission Installation Contracting Command at Fort Sill issued to Tolliver Group 2 separate task order contracts under SDVOSB set-asides under the federal supply schedule. People, Technology, and Processes filed post-award challenges to both of those orders, and the Army, in response, took corrective action. And as part of the Army's corrective action, one of the things that it did is it looked and it said, hey, we have an IDIQ that would allow us to purchase all of these various services and that we are requesting. These are for instructors for various Army courses. And the Army had an IDIQ vehicle that it would allow it to purchase these services under. So the Army then canceled the contracts to the Tolliver Group and resolicited this under an unrestricted IDIQ. And Tolliver filed a protest challenging that cancellation, alleging that it violated the rule of two, essentially saying that, hey, because the rule of two was met in this circumstance, your cancellation decision was improper, and instead you should have solicited this among small businesses. Interestingly enough, PTP, the protester, originally intervened in this protest, and then eventually kind of switched sides and ended up making the same arguments challenging the cancellation decisions as the Tolliver group did. But this case is interesting, I think, for two reasons. The first reason is it was a task order, and it was or ostensibly a protest challenging a task order. And one of the first things the court considered through a rather lengthy analysis is whether it actually had jurisdiction to consider this challenge under the Federal Acquisition Streamlining Act, which in most cases prohibits the Court of Federal Claims from considering protests challenging awards to task orders. And the court's analysis was pretty involved in that question, and it considered, the interplay of the Tucker Act, the Federal Acquisition Streamlining Act, and also the Competition and Contracting Act, and ultimately concluded that it did have jurisdiction to consider the challenge. One of the reasons why is under the Tucker Act, according to the court, the Tucker Act grants jurisdiction to the Court of Federal Claims in 4 specific instances. The 4th instance is any alleged violation of statute or regulation in connection with a procurement or a proposed procurement. The government claimed that the court did not have jurisdiction over the protest to the extent it involved application or a challenge of the government's application of the rule of two. The court noted in considering that the FASA bar, the jurisdictional bar, prohibits protests in connection with the issuance or proposed issuance of a task order unless that task order changes the underlying scope or dollar value of that underlying contract. And so the court was left with the question of, under the Federal Acquisition Streamlining Act, is this challenge to the cancellation decision here, is that a bid protest as is contemplated under FASA? And the court said, ultimately, it's not. It noted that neither the FASA nor the Tucker Act actually defined protests. So there it looked to the definition under the Competition and Contracting Act. And it noted that this action brought by Tolliver fell under that 4th prong of jurisdiction to the Court of Federal Claims, this a challenge to a violation of statute or regulation in connection with a procurement or proposed procurement. And the court said this isn't technically a protest. It doesn't challenge the solicitation or the proposed award of a contract. Rather, this action challenged the cancellation of the Army's procurements. And in any event, the court noted that FASA applies only to the issuance or proposed issuance of a task order. And here the challenge was to the selection of the contracting vehicle itself, which came before the actual issuance of the task order. So it's a really interesting jurisdictional question here from the court on whether it had the ability to consider this protest. And if you are considering a protest challenging an action by an agency relating to a task order, I know that the kind of reaction is to say, oh, Court of Federal Claims is generally off limits. Maybe not. I mean, I would take a look at Tolliver and see if there's any way you can thread that needle. It was a very lengthy discussion by Judge Solemson about whether the jurisdictional bar applied, and it could be of some help to you. Going towards the merits, however, the actual application of the rule of two, the court found that the Army erred in failing to evaluate the rule of two. FAR 19.502-2B says that the contracting officer shall set aside any acquisition for small businesses that are over the simplified acquisition threshold when there is a reasonable belief that 2 or more small businesses will submit an offer at a fair and reasonable price. And the court, in its interpretation, considered or found that shall apply to any acquisition was pretty determinative. Now, the government argued that the 2010 Small Business Jobs Act changes that analysis. That is at 15 USC 644 sub R. The government has discretion, or an agency has discretion, to set aside parts of a multiple award contract for small businesses. And so the court considered whether this discretion, whether this 2010 change essentially made it so that the mandatory nature of the rule of two was impacted in this case. And the court said ultimately, no, it doesn't. That in the court's mind, the discretionary change talked about how the agency or how a multiple award contract may be structured, or how a task order competition may proceed. It did not affect what the court called the foundational question of actually determining the procurement vehicle. And here in that case, it's to that question, the procurement vehicle at issue, that the rule of two analysis needed to apply to, according to the court. And since the court knew, since the agency knew that there were two or more small businesses at issue here that would submit a bid, its decision to issue this as an unrestricted procurement was improper. Okay, next slide, please. All right, so now we'll see the other side of that coin, and that's from our friends at GAO. And in late 2020, GAO considered really kind of the same question and reached a different decision in Itility's bid protest. So in 2018, Itility was awarded an SDVOSB task order by the Department of Homeland Security for various program and technical support services. By 2020, due to changes within the agency and kind of increasing branches that were subject to this task order, DHS decided it needed additional labor categories and additional functionality under the task order that the task order didn't currently contemplate. So it decided to re-procure those services under a different vehicle. And the agency in its analysis considered several different options. It considered releasing it under OASIS, under VETS 2, and under 8A, GSA 8A STARS 2 to issue this new procurement under. It ultimately released the procurement under Alliant 2, which was not a contract that was held by Itility. So Itility, DHS then awarded the contract to an outfit called EIS for about $60 million. Next slide, please. Once Itility heard of this award, it was understandably a little upset, and it filed a protest challenging the decision to issue this re-procurement as through Alliant 2 on an unrestricted basis as a violation of the rule of two. The first thing GAO considered, though, is whether Itility's protest was timely. The agency argued, essentially what happened is Itility was challenging the makeup of the solicitation. The agency set aside determination, which is in general a pre-award or a pre-bid protest challenge. It's a challenge to the terms of the solicitation. Itility brought its protest after the award, and the agency and the intervener both said, hey, this is untimely. You need to dismiss the protest. GAO said it wasn't untimely for two main reasons. First of all, it was issued under Alliant 2, and Itility was not an Alliant 2 holder, and so it didn't have notice of the solicitation. It didn't know, and so it filed its protest when it, within 10 days from when it learned of the award to EIS. The other thing GAO said is, well, when the agency released this, released its procurement planning relating to this competition, that didn't put Itility on constructive notice about the award either. And it said, well, first of all, agency, you didn't send this out through beta.sam, which is the GPE, the government-wide point of entry for these notices. And in any event, this is just acquisition forecasting. This isn't a solicitation. It wasn't any type of notice here that would have put Itility or made Itility's protest clock start to tick. So the GAO decided that Itility's protest was timely. However, it denied the protest. And GAO, again, considering the same rule of two, FAR 19.502-2B, said that the Small Business Jobs Act of 2010 did make this discretionary. And though the court in Tolliver was noted just the opposite, that, hey, you know, the FAR is mandatory and the Small Business Jobs Act doesn't really apply to this situation, the GAO, relying on some of its existing authority, found that determination to be improper or incorrect, I should say. GAO specifically disagreed with the Tolliver decision. One of the things that Itility and the SBA argued, in fact, that made this decision, or that made the facts in Itility distinct from when GAO has considered this question in the past, is that in this case, Itility was, what it said, is outside of the IDIQ. That is, it doesn't actually hold the IDIQ. And both Itility and SBA said that's enough to really change the circumstance so that this rule of two should apply. GAO rejected that argument. It said, you know, listen, there's no support for this in the Small Business Act or in the FAR. There's no distinction between being inside or outside of the IDIQ. Moreover, if GAO were to invent that dichotomy, in its opinion, it would grant small business contract holders that didn't hold the IDIQ a greater ability to challenge than one that actually holds the IDIQ. So in GAO's mind, the FAR 19.502-2B, this mandatory rule of two, is still discretionary when it comes to the decision of whether to set aside orders under a task order. And so we do see a distinction here, at least between one judge on the Court of Federal Claims and GAO about how to interpret the interplay of these statutes. And so certainly keep that in mind if you have a client that is potentially challenging some of an agency's decision to set aside or not in order under an IDIQ. Next slide, please. All right, the final thing I'll talk about before handing over to Shane is essentially an update as to how joint venture profits or joint venture revenues need to be included when we calculate small business size. So under SBA's regulations, back in 2016, SBA changed its regulations to prohibit a joint venture, small business joint ventures, from being populated entities. Populated entities are those entities that actually employ the individuals who perform work under a contract. Under SBA's regulations since 2016, a joint venture must be unpopulated. It can have employees, but they really are administrative employees. It cannot actually employ those individuals that will actually perform under the contract. And also under SBA's regulations, 13 CFR 121.103H5, a joint venture has, or excuse me, when calculating a small business's size, it's required to account for its proportionate share of joint venture receipts. So this came up in a case in 2021 called Swift and Staley. And essentially what happened is Swift and Staley bid on a small business set-aside contract under a $41.5 million size standard. Now, Swift and Staley is also a minority owner of a populated joint venture called Portsmouth Mission Alliance. PMA did not bid on this contract. It was a separate contract that SSI bid under, but SSI's size was challenged. And as part of that size determination, the SBA area office determined that that SSI's proportionate share of its PMA joint venture revenues need to be included in SSI's own receipts-based calculation. And when it did that, When the SBA did that, it determined that SSI was an ineligible large business. SSI appealed this decision to the OHA, saying, no, these receipts should not count. This is not a small business joint venture. And OHA nonetheless affirmed and said, no, these receipts need to be included in your size standard. Next slide. So SSI then took this matter to the Court of Federal Claims, and the Court of Federal Claims said essentially that because the joint venture was populated, it did not meet SBA's regulatory definition of a joint venture. So therefore, applying principles of statutory construction, the Court of Federal Claims said that subparagraph H5, which is that provision that requires the proportionate share of joint venture receipts to be included in the small business receipts, did not apply. According to the court, any use of the term joint venture within paragraph 8 in its subparagraph refers only to the joint venture that meets SBA's regulatory criteria, the small business joint venture. A populated joint venture does not meet that requirement, and so therefore, populated joint venture receipts are not required, according to the court, to be included in small business receipts for this. And so the Court of Federal Claims determined that the SBA's decision was erroneous. But it doesn't end there. Next slide, please. Because just late last year, or excuse me, early this year, SBA has pushed back on Swift and Staley. It has issued a rule effective January 5th, effective immediately, 2022, that essentially clarifies its definition of joint venture receipts and what are included in that proportionate share. And SBA makes clear that the proportionate share of joint venture receipts, whether the joint venture is populated or unpopulated, have to be included within the small business receipts. And so SBA has pushed back on that Swift and Staley decision. And if you take a look at H5 now, it does include that notation of whether populated or unpopulated have to be included in those small business receipts. And so with that, that's all I have. I certainly appreciate everybody's attention today. And with that, I will turn it over to my friend Shane.
Thank you, Matt. Appreciate that. And Sam and everyone on the panel. I don't have a lot of time here, so I'm going to have to go through this a little quickly here. But there's some important additional updates in continuing that theme of joint ventures, popular vehicle for small businesses to go after contracts, of course, and also some quick updates on past performance for small business when they act as subcontractors and also through joint ventures. So the first case here, InfoPoint case, came out last year. It goes to these important points about, security, facility clearances are of increasing importance in federal contracting, in the IT arena for certain, and in other types of contracting as well. With the Department of Defense, it's been difficult for joint ventures over the years to sometimes to go after contracts that required facility security clearances, or FCLs. DoD for many years, and even now, the website and the pamphlet for getting security clearances still says that a joint venture itself has to have an FCL. That's still up on DoD's website, but SBA had issued a rule that followed up on some guidance from the National Defense Authorization Act from 2020, basically requiring that the joint venture entity itself did not have to have a facility security clearance if both of the joint venture members had that. So DoD put out a solicitation that would have required the joint venture entity itself to have an FCL. Protester challenged that on the basis of there being an SBA regulation and a statute that said that a agency cannot require the joint venture entity itself to have that FCL. This went before GAO. So what the 2020 NDA said, clearance to access a DoD installation cannot be required for a joint venture. if the joint venture entities are cleared for access. And then the SBA rule was along those same lines. A joint venture can get a contract if either the joint venture itself or either of the parties has that facility security clearance. So DoD, despite these SBA rule and the statute from Congress, went ahead with this solicitation. Now, when it was at protest before GAO, DoD argued that it has been delegated the authority over national security issues, including security clearances. GAO should defer to its interpretation. At GAO, though, that argument did not win the day. GAO found in favor of the protesters, said that the solicitation requirement that the joint venture itself had to have a facility security clearance is contrary to both statute and SBA regulation, and recommended that it be revised. And I've worked on other cases where these similar provisions have been found in different DoD procurements that also seem to violate this rule. So it's a good outcome for those using joint ventures to go after procurements that need facility security clearance. So we can go to the next slide. This next case, Innovate Now, also involved a joint venture issue, and in this case, it dealt with past performance. So, one case dealing with security clearance and joint ventures, another one, what level of past performance do each member of a joint venture have to have? So this solicitation that was in question here said one work sample at least has to be submitted for each member of the joint venture, one corporate experience example. However, SBA's rule that you see up there in 125.8 and also in similar joint venture rules for other types of small business joint ventures, it says an agency can't require the protege to have to meet the same evaluation criteria as other offerors. So GAO in this case also found in favor of the protester, said that the solicitation term violated this specific SBA rule because it did require the protege member of that mentor-protege joint venture to have the same level of experience as other offerors. They had to have this one minimum requirement, this one minimum corporate experience example. So that again told the agency to go back to the drawing board because they were making it more difficult than they should for joint ventures to submit bids on these types of procurements. Okay, we'll go to the last slide here. And then real quickly, there's an SBA proposed rule that's also going to be helpful for small businesses. And it actually has two components to it. The first one is that once this rule becomes effective, it's still in the proposed stage now, but once it becomes effective, an agency has to consider the past performance of a joint venture if it's evaluating that small business's proposal as a member of a joint venture. So basically, a small business can use its experience from a past joint venture to fulfill some of the past performance requirements for meeting the minimum requirements on a solicitation. So it'd be helpful for small businesses in that context. And a similar rule says small business subcontractors can now get evaluation ratings from their large primes that they worked with. It's going to be similar to a CPARS rating, have things like technical cost management, those sorts of things. Small business has to be working as a first tier subcontractor, and there's some specific requirements and some deadlines for that prime to respond. So this is an important rule when it comes out. Small businesses can get better, more thorough past performance ratings, but primes have to be aware of this in their subcontracting plans, another requirement that they're going to have to be aware of and comply with. So those are some of the big news in the world of small business contracting. And I'll turn it back over to Alan to take us out.
Gentlemen, thank you very much. This is an interesting regulatory area. Congress has taken some action legislatively. SBA has been acting and takes the FAR Council a couple of years to catch up with the SBA rules, but they seem to be doing so, and we expect more next year. So we may have you back for an interim session. I don't know if we can wait for another whole year to catch up on this, but thanks very much to Sam, Matthew, and Shane for an outstanding presentation, your participation. Let me again thank all of our sponsors for their participation and support of this program, both on this slide and as well as on the next. Thanks for joining us and look forward to seeing you at additional pub case sessions.